Before starting today's video, I've got two disclaimers. The first is, all the information you're about to hear should not be considered to be investment nor tax advice. I'm not a CPA. The second disclaimer is, this has to do with taxes. This stuff is dry as a bone, folks. If you want to click off now, no hard feelings. But if you want to stick around for 3 minutes and just see what happens, let's go. Knowing which accounts to draw from and in what order can be the difference in retirement planning success or failure. Spending down taxable accounts first can dramatically improve outcomes. This approach can reduce exposure to ordinary income, take advantage of long-term cap gains treatment, and potentially keep more of your income in the 0% bracket. Here's a quick example. Jack and Diane are 56 and both retired at the end of 2024. In 2025, they sold $160,000 in assets from their brokerage account with a cost basis of $80,000. And let's assume they take the standard deduction of $31,500. Here's a breakdown of total income for 2025. Don't worry, I'm not going to stand here and read all these line items. Let's just go to the adjusted gross income of $97,500 and apply the $31,500 standard deduction, and arrive at a total taxable income of $66,000. Federal income tax liability, zero. When you withdraw from taxable accounts first, non-qualified dividends are often offset by the standard deduction, and the qualified dividends may fall in the 0% long-term cap gains bracket. In contrast, let's look at John. By the way, folks, John's about to blow it. I first named him Fredo and then changed it. John, also age 56, draws $80,000 from a traditional IRA, thus triggering ordinary income, as well as a 10% early withdrawal penalty. The ordinary income can force qualified dividends from the 0% bracket up to the 15% bracket, and force non-qualified dividends from 0 into the 10, 12, or 22% brackets. I told you John was going to blow it. Tax savings realized by tapping taxable accounts first can also reduce one of the biggest retirement risks to early retirees. It's known as sequence of return risk. This is the risk of poor investment returns early in retirement. Two retirees with identical circumstances, but different retirement dates, can experience vastly different results depending on the market conditions experienced a few years before and after retirement. The period I call the retirement transition trap, where increased spending coupled with poor market returns can wreck your retirement plan. This is where you can really dig a hole. Reduce expenses early in retirement to mitigate this risk, because the fewer sales that early retirees have to make, the less exposure they have to market downturns and withdrawing from a declining portfolio, which is akin to eating the seed corn of your future growth. There's one exception to the general guideline of spending taxable accounts first. It's when an inherited IRA with a substantial balance is involved, as you may be required to distribute the entire balance over a 10-year period, which of course creates significant ordinary income pressure, and you have to plan around that. And finally, depending on your legacy goals, you may wish to preserve highly appreciated assets in your taxable account to take advantage of the step-up in basis when you pass. If you found this video helpful, please like, share, subscribe, or leave a comment. And if you'd like a free second opinion, click the link below.